So in order to explain what we are going to cover today, in earlier sessions on hedge fund, we had discussed about the overall master feeder structure and how the hedge fund operation works in terms of what is the role of the feeder and the master and who is making the investment into the market. So these are high level information we discussed in the last session. Today, we are going to cover overall strategies. There are 5-6 key strategies in hedge fund. We will be talking about that, plus hedge fund operations, the different stakeholders, the players in the hedge fund market, what is the fund accounting, trade life cycle, again at a high level, because given the time constraint, we cannot discuss everything in such a vast field. Also, we'll talk about the fund operations, how the different activities are performed before the NAV is calculated for the fund. So these are some of the objective and the milestone for the discussion today. And as always, feel free to raise and ask the questions, and we'll do everything to answer that. The only limit that we'll have is the time. However, we can still discuss some of the key questions. Okay. In the earlier session, we had already discussed the fee calculation, hurdle rate, IRR, waterfall, actually high watermark methods. Those things are already discussed. What is the management fee, how it is calculated. So today we will skip them, as we discussed at length, series accounting, equalization accounting, and all the nuances in the earlier sessions. So today we are going to make the progress afterwards. Make sense?
Yes, okay. Good to go.
Perfect. So there are some of the aspects we had covered earlier, and now we will make the progress on additional items. So unique source of return, the hedge fund as the alternative investment is unique source of return, because traditionally the finance market and the investment market was getting the fund from the banks or directly the individual investor. But when AI came, AI means alternative investment, this is largely unregulated and invested by qualified investor, right? We all know this one by now, because they have to have a sufficiently large asset and pool, plus they also need to be able to bear risk. So from those perspective, the qualified investors need to have sufficient margin and risk appetite in order to invest into hedge funds, because this is unregulated and it could be riskier than traditional mutual fund or a fixed income product, which is invested by people. So essentially, this is again the compensation and the fee part. We can skip these ones. Next is investment style, and what are the different strategies followed by the investment manager. So in terms of the process of portfolio management, first investment managers discuss and draft the PPM, private placement memorandum, which also incorporates the different objective of the investment, the risk profile, return profile of the fund, and that has to be consistent with the risk and reward objective of the investors as well. That's why the investor profile is also important before they invest into any hedge fund. Later we will discuss there are 6 different types of hedge funds. So not every high risk seeking investor would like to invest into different type of funds, not all type of funds, because it also has to be their cup of tea, what kind of risk they want and what is their return horizon. So that's why we need to establish the objective, constraint, and thereafter the investment management policies are drafted, which is part of the private placement memorandum as well, the documents. We have discussed that this is invested by endowment fund, pension fund, institutional investors, because they have big risk appetite and also they are looking for a better return. So just wanted to refresh your memory on this. And now we will be moving to the actual topic for the day, which is the players of the hedge fund industry. What is their role? What is the typical day of the NAV process? And different elements, how the NAV is calculated, how it is reconciled. Plus, we'll talk about the different types of investment strategy. So Nihar, anything before we continue, any other clarification that you want to give?
No, I think you've covered a summary of the topics we are going to talk about. So, yeah, happy to proceed. Thanks, Nidhish.
Thank you. Anyone from audience? Anything specifically you want to add, subtract for today's discussion?
Good to go, Nidhish. You have give the brief of all the topics that going to be discussed, and I think that would cover all.
Excellent. Thank you. So, in terms of other players, you see custodian, depository, prime broker, and trader agents are listed here. So, essentially, custodian play a very important role in terms of that they are the ones who will be the maybe caretaker or basically the watchdog for all the investment and the assets. So basically what happens is the regulation required back in 1970s, 1980s that investment manager, you can call them GP or the trader, etc. So largely speaking, investment managers, they are the ones who are investing into market, right? And also, how do you assess their performance? So there has to be a performance report, naturally. Imagine that investment manager also tells you that these many trillion or maybe billion, trillion dollars of assets are there. So you will never know what is the reality. What if one of the investment manager had sold significant part of the asset and it was never reported to you? Because investment manager is making the investment decisions, taking care of your cash and money, and also reporting their own performance. And they are the one who are holding entire equity, stocks, everything in their record and treasure. So you will never know what is the real asset. And maybe for a couple of years, you are still in the darkness. So regulation came in effect and said that every hedge fund manager, they need to appoint a separate custodian in order to maintain transparency. And then the investment community, investors will also get an independent report as to how much assets are there for the given fund. Also, their role is important because they'll be provide the summary of all the asset, equity, bonds, everything, which will be used to reconcile by fund admin as well. Hence, it is important. Hence, it is important that the investment manager has custodian appointed. Then comes the depository. After the trade takes place on daily basis, it is also sent and verified by the depository. We will see in the in more detail in the forthcoming slides. There is a regular and daily interaction between the traders of the security and the depository to confirm the position which is bought or sold, both. So that is the role of depository. And after confirmation with the depository and the broker, the data is sent to custodian to confirm that, hey, today we have sold 100 stock of A and bought 50 stock of B, so on and forth. So that is the difference between the custodian and depository, and that is their role. Yeah, Nihar?
Yeah, so I think Sam had a question. He asked what's the difference between a investment bank and a custodian.
Yes.
So I guess a bank is an investment bank is just it's a company, it's a private company that provides all financial related and other services to individuals, whereas a custodian is a gatekeeper of the assets that the bank would invest in, that Nidhish just went through. I hope that answers your question, Sam. Hi, Sam. Are you there? Yeah. Okay. Fine. Good. Because and just to add to that, the custodian is where all the assets are held. So the assets are held in the name of the custodian. So they have the legal ownership of the assets.
Could you please repeat the statement, Nidhish, what you were saying? After confirmation from the depository and the broker, then the custodian is to act, correct?
Yeah, so once the trade is executed by the trader and for the day, it will be confirmed with the depository on the same day basis that it has been executed on the exchange, how many securities bought and sold from the batch. And once that is also confirmed, that means the trade is fully and officially executed. That summary is shared with custodian, the client, as well as the fund accounting team subsequently, because all the three parties have to reconcile the data and understand that how much trade has been executed for the day as opposed to what was ordered. So that is the role of depository. And custodian is, as Nihar also explained, that it is a kind of a bank. Just like the bank holds all the cash, the custodian will hold all the assets of the fund, basically, and on time to time they will be reporting as well how much of each asset they have, because there will be an independent check in that way. Because before, does it answer your question, Varnish?
Good to go. Good to go.
Okay. And thirdly, as we can expect now, prime broker. So prime broker is providing the brokerage services, the buy and sell services, execution of the trade orders on daily basis. And the reason they are called prime broker, because one prime broker might have various sub brokers in different countries. So say, for example, Nihar sitting there in London, every morning 8 a.m., he opens his desk and say, okay, so I think the world is settling on GameStop. Let me go for some further speculation. So he wants to sell some 5,000 stock of Nidhish PLC. Am I assuming too much, Nihar? Oh, so Nidhish PLC, right? So he gave the short sale order to the prime broker. Now the prime broker cannot really execute that many short sale order sitting in London only. So he or she will give that mandate to 10, 15 different sub brokers all across the world on different exchanges to execute sale of 500 or 5,000 Nidhish PLC stock. And they will start working. And at the end of the day, they might come back saying coming to prime broker saying, you know what, only 80% could have been executed. Out of 5,000, only 4,000 has been sold short today. And primary broker will say, okay, it is what it is, and will report to the client saying that we could not execute all, but 80% has been done. So that is the role of prime broker, to act as a central and the key broker to execute buy and sell orders with help of all the other sub brokers across the world in different time zones as well. So it's not only one place or one broker. It is kind of master broker of all the brokers who will be the primary contact of the client in order to buy or sell something. That's why it's called prime broker. It doesn't mean that they are the only ones who is doing buy and sell. Yeah. And also, it does not end there. Of course, they have many other roles to play, but important one is they can also finance your trades. It is not just they will execute the order. If the fund manager do not have sufficient cash, they can even do the margin trade, and their prime broker will assist in arranging the fund to do so. This is where the leverage comes in picture, and margin trades take place. And not to forget, whenever the leverage is involved, the return or loss is just magnified. Hopefully, we might be covering that one as well in some of the sessions in future. It is entirely a new chapter. So that is the role of prime broker. And then comes the traders and agents. So
Yeah,
the prime brokers will have the traders. Yeah, Nihar, maybe the fourth point you can.
Yeah, I'm just going to give an example, just to give a few names of the prime brokers. We've got Goldman Sachs, JP Morgan, Credit Suisse. These are the big investment banks that are also provide prime broker services, and it serves the need for the hedge funds, which can be quite complex.
Can we say that all investment banks are prime brokers? Is statement correct?
Not necessarily. So some of the big banks, as I said, is Goldman Sachs and Credit Suisse and JP Morgan, etc. But just because they're an investment bank doesn't necessarily mean they might take the risk of prime broker. It's a separate business arm. Barclays is also one of them, Sam.
Could you quote examples which are not the prime brokers and which perform other activities of some companies or banks? Would be that asset management companies, we can say they are not the prime brokers, or can be?
No, just a different business. It's a different business arm. So I think Sam just said he works for Barclays. So Barclays also acts as a prime broker. So so some banks are in insurance. Some banks have insurance, prime broker services. They act as a custodian, but they are investment banks. I mean, let's take an example: Aberdeen Asset Management, right? So that doesn't act as a prime broker. It's purely an investment bank. It's an investment manager, right? But then you've got BlackRock, which is it's an investment manager. It also provides prime broker services. Same with Barclays. So it just depends what business you are in. So as an investment bank, you might use other prime brokers. So you could have multiple prime brokers. Does that answer your question?
You mean the activities would decide that it would be a prime broker acting as a prime broker or not? When financing the trades, margins, Nidhish has already explained, right?
Correct.
Okay, thank you.
Yeah. Actually, it is a very conceptual point. I think we can have one of this futures discussion on the investment bank and its role only. I think because it's a very complex business. One investment bank can have different hats, and investment bank itself can have their own funds as well, like JP Morgan Global Macro Event Funds, right? And JP Morgan can be a trader as well, and JP Morgan is a prime broker as well, right? So custody business as well. So one investment bank can have almost all the different colors of the businesses: merger, acquisition, equity trade, advisor, so on and forth. So that's where basically every single word has a room for a separate discussion. But this is the overall understanding. One IB plays almost different hats, especially when you talk about maybe even Nihar, you can add up, but BNP, JP Morgan, Citibank, these are the banks which are so large and vast, they wear different hats.
Just one query. The all activities, if we summarize custodian and prime brokerage, if there is an investment bank, it is by default he has been licensed for all the activities, or they have to get the license for particular activities?
They have to get for different activities. This is like a multi-speciality hospital, right?
Oh, great.
So just because one hospital has a license to admit patients and the ICU doesn't mean they can perform various kind of surgery testing. So they need to develop expertise, specialty, brand, market, license, doctor, technicians, all those things one by one. And that's what a bank like BNP, CP, or JP Morgan look like. They have to develop expertise and get the license, not only in those vertical, but also in different markets, in different exchanges.
Yeah, no, exactly. To put it in context again, I think for prime broker, the main revenue stream for a prime broker would be that it would lend money um, on margin to hedge funds, so that they can invest in the market, and it makes its money through commissions, for example, and optimizing its cost of funding. Okay, so that's the revenue for prime broker. The revenue for investment manager will be management fee, performance fee, right? Revenue for a custodian is the fact that it holds all these assets on behalf of the clients. So then it can earn interest on that. So then these are all different businesses. So just think about, one company and how many different licenses you want to hold, how many different services you want to provide. That's all that is.
Great. Thank you so much, both of you. Good to go. We can proceed.
Fabulous. So the next topic is the structure of the hedge fund and how all these players that we talked about are linked up. So this one is a typical hedge fund. This time maybe I can say Nihar Hedge Fund PLC. Okay. So here there'll be Nihar Fund will have a fund administrator. Okay. Maybe this is Varnish Fund Accounting. Okay. So what you do on daily basis here, you'll be getting the report from the hedge fund IM manager on daily basis that he or she has done the trade in such and such securities, buy and sell. And based on that, those positions, you'll try to reconcile what is the total of the portfolio, or maybe how many Infosys, TCS, or HCL stock has been bought or sold. Basically, of course, it will be much more globalized securities name, but you'll get a report from the IM. Then you also reconcile that with custodian book. So in that way, you can reconcile the book from the book between the IM and custodian and find out any break or any differences in the price or in the quantity or any such factor. Based on this, you'll confirm who is right, whether hedge fund or the custodian, and the client will confirm which number is correct most of the cases. In some cases, you can also go back to custodian if the client says no, their number is right. So custodian has to verify. So this way, we do 2 or 3 ways of reconciliation as well. Hedge fund manager, they are largely part of the hedge fund. We usually say hedge fund because hedge funds are managed by the hedge fund managers. They are the IM. Of course, they have the board of directors and other players as well. That's why hedge fund manager is reflected separately here. Now, hedge fund manager, as we said in earlier example, that suppose that Nihar is one of the, he is a hedge fund manager and he is giving the kind of trade order to the prime broker every morning. So prime broker will be the one who will execute the order, and as we discussed earlier, will send one file to custodian, also confirm to hedge fund and hedge fund managers, and this is the way all the way different reconciliation takes place. So this prime broker will have the information with will share the information with hedge fund, will inform to custodian. Custodian will share the file with the fund admin, and fund manager will share the file with fund admin. Fund admin will reconcile all the informations and will do the daily or monthly NAV. So this is how all these players are linked. Sorry, all those who are not speaking, please stay on mute. Next.
Nidhish, I have a query. Hedge fund manager and IM both are same? Can be same?
Yeah, their roles are interchangeably defined. So hedge fund has various different professionals. So that's why we call them hedge fund here. But hedge fund managers are those who are taking buy and sell or active management decisions. with regard to the market. So hedge fund manager are part of hedge fund, and they are IM. They are also called GP in the partnership structure. They are called GP in limited structure. They are called investment manager. And again, within investment manager, there are various professionals. Some will be the trader, or some will be just the researcher, and they will be taking the investment decisions on daily basis or regular basis. And they are also not like having the supreme authority for the funding investment decisions. They also have to often get the clearance from the board. They also have a board of director in order to kind of go beyond certain limitations, or if they are taking some additional risk, they have to get the approval from the board of director as well. So this is the structure followed.
So we can say the hedge fund manager, different terminology in private equity can be said GP, and in hedge fund as an IM. It can be, I mean, used in different terms.
No, the hedge fund manager as a role, as a JD, is the same. They are called IM in limited.
Okay.
They are called GP in partnership. However, if we don't have to look into the differences between the LP and partnership, they are largely hedge fund manager, right? It's just like we are all employees, whether it is a PLC company or a LTD company or a partnership. Employee is the best term to explain everyone. In the same manner, hedge fund manager is the best term to explain. It is like a JD, but officially their designation can be like IM or GP in the different structure.
Okay, thank you so much.
Now, life of a trade. So Nihar, keep adding. Definitely, you will have some additional good points. So in the life of a trade here, we can just zoom a little. Are you able to see all the different elements? Is that clear enough?
Could you please do a bit zoom so that it can be more clear?
Yeah, I'm just going to enlarge this.
Yes, now good.
See now, yeah. So the trade start when investment manager in the morning gives the trade request, trade input comes, and it is as in the format of the FTP and different software-based input. So that goes to the data transfer back office as well. Trade processing is done. So trade verification is done, and that's called trade processing, trade executions. So this is a two-way process. As the trade verification is done and the trade processing is confirmed, the data enhancement is done just to clean up the data or provide the different security ID, check the consistency of the data that is provided in the file. So trade enhancement, data enhancement is done. Confirmation document is prepared, because that confirmation requires kind of a second check. It is not that the trade is still taking place, but the trade confirmation will just validate all the information before the final confirm is done. Because once the confirm is completed, internal authentication will be done, and the client means the IM or investment manager will ensure the data is entered in their system, because they also maintain one system on daily basis. So before it reaches to IM, this is the process that trade confirmation is done based on all the different steps. So 1, 2, 3, 4, 5. These are the various steps which is followed before IM gets the final confirmation that the trade has been successfully executed. One thing, confirmation is done officially. Every team has checked the data which is entered in the file before the confirmation is completed should make sense, like a buy, sale, plus minus, or the security IDs, exchange name, the price, the cost, all details should be quite accurate. So this is one flow that is followed. There's another link, there's another path here which is running in parallel, is legal execution and confirmation with the counterparty. So counterparty means those who are confirming the trade, or even the depository, the traders, brokers, they will be working on the confirmation process check. So they will confirm the trade details, whether it is accurate or not, and how many trade has been executed as against what was requested. And they will be providing the documents, evidence that the trades are executed, because those documents will be used as attachment to evidence the trade execution. So this is the trade processing part. So is a role counterparty, and I am the fund manager's own team are playing. Brokers, traders, everyone is engaged in this process.
And
Any question on this part?
Trade verification part. I mean, what is they're going to verify? The security ID, the price setup, all that stuff.
Yeah, buy, sell, price at which it has been confirmed and completed, what price the manager had asked for. Okay, because when the trade order is given, if you are doing the trading yourself, you will be specifying a particular price, right? Beyond which the trade should not be executed. What should be the quantity Q? Which exchange it need to be bought or sold? QC ID, ISIN ID, and all these details are entered into the file. So this is where the data enhancement and confirmation preparation dockets are involved. And though it is one flow to the office of IM, but at the second part of it, the counterparties are involved. They will be providing all the essential information that we talked about here. Varnish, you're saying something?
The IM approval is required. I mean, before sending the confirmation, or it is after the confirmation? I mean, the IM is to prove the trade. Just approval is required somewhere.
No, IM does not do the confirmation. IM gives the trade order, right? So every morning, IM will be based on their own details, basically. Just give me 1 second.
Sure.
Or Nihar, maybe you can explain. I'll just
yeah, sure.
take some calls.
So I think what you're asking is, IM needs approval for the trade. Is that what you're asking?
IM has to prove that trade, that this has been correctly done. So I just want to confirm that when we send the confirmation to the investor that the trade has been booked and so instructions are there.
Okay.
In after that, when we receive the information, only then the IM has to approve the trade, or IM has to give the trade approval before the confirmation to the investors. That's my question.
Confirmation before the, okay, so basically, right, there is investment guidelines. Okay, so the IM is placing that trade, right, based on the investment guidelines. So so that is one thing, right? So what happens is the IM has said they want to buy XYZ, and then that is then settled by the counterparty, right? So basically, it's just an agreement, right? That is taking place. So the confirmation will not be sent to the client until the trade is on the books, which is the trade is on the report of the custodian. Okay, so the trade will only get onto the report of the custodian when both parties are matched. In other words, the buyer and the seller. So in this case, the client wants to buy something. In between, there's counterparty, right? So basically, until the trade is executed, not necessarily settled, okay, it will show up as it will not show up on the custodian's report as a trade being executed. Only when it's fully executed, that's when it will the client will get the confirmation that the trade has been executed. So there's various different reports that that the client will receive from service providers, for example, that this trade is finally being executed. And when they do the when the reconciliations also performed, so the client has expects in the portfolio the new purchases, then that will also be on the custodian side, the counterpart, and then also on the administrator side. So as long as all everything matches, then the trade has been executed, for example. But you also have trade tickets to confirm that.
Okay, good.
Does that answer your question?
Yeah. I mean, in some processes or somewhere in initial process after booking the trades, there is a requirement of, I mean, the trade approval, or we can say after booking, inputting the IAM approval or the GP approval. So I think that may be the internal authorization process
No,
somewhere
no.
in. Yeah.
Yeah. Okay. So what you're saying is yes. So that's a common practice in the in say private equity, for example, right?
Correct.
And that's what you're referring to. So that's okay. That's a different, because you don't get automated confirmation. So you
Oh,
have the client wants to know that the trade, it has been executed, and etc. Because every trade, there's interest associated, and the main revenue is the interest amount. Okay, so
okay.
from the client's perspective, yes, the sign off has to be done by the client. So what happens is the trade goes to the counterparty, right? Then or the loan trades team, whatever you want to call it, and then the client will have to sign that trade ticket. So in the private equity world, because because these are not assets, there has to be internal confirmations.
Great. Thank you so much.
No problem.
All right. So with regard to the trade processing, this step is done. Post trade processing, is anyone involved in this on any hedge fund company? So basically, once the trade is processed and confirmed with the counterparty in the IM, we get payment advice, especially this confirmed by, again, the hedge fund admin team. The cash is transferred from one account to another one, admin account to maybe Nostro reconciliation control, or the payment is made to the broker. So the admin and the cash account, various accounts which are maintained for various margin account, the cash transfer is executed after the trade is processed. That will trigger the position reconciliation as well as the cash reconciliation. So on one hand, we have position recon and also the cash flow recon, which is here. This is on the basis of the rate, fixed rate, the payment calculation, and then how much cash has been transferred and how much is accrued, any liability that will be reconciled with regard to the overall cash movement. So cash flow reconciliation, the position reconciliation needs to be done on daily basis, ideally, in order to have a complete hold on the cash position and the quantity of the different stocks or bonds executed or bought on daily basis.
I mean, the accounts which you were mentioning, Nidhish, I think that was dealing date account and DDA account and the prime broker account, where, I mean, the dealing date account of the fund and the prime broker account where the cash is movement for the payment. I mean, that comes into picture, I believe, in this, the payment advice and the funding and payment processing. These are the
Yeah, both has to funding and the position account, both has to work together, because
yes.
on one hand, the funding will be reduced, the position will go up, we have to reconcile the position and the funding and the cash flow both. And this way, on daily basis, we'll have the complete track of the NAV, because these are important components.
Where would this rate fixing and payment calculation comes into picture, and how would this comes into picture? Could you please explain a bit?
How the payment comes in picture?
The rate fixing and the payment calculation into cash recon. I mean, how they comes into picture and how these are done in the cash flow reconciliation.
Okay. See, rate fixing is basically the margin. So there are many components of this. It is not one particular type of activity. So rate fixing is an umbrella term used for margin rates, repo rates. It's like another complete activity. So there are repo rate between the different banks, and when the company, when there is any collateral by the fund and the fund is borrowed, there will be a repo rate applicable. So for that also rate fixing is done. Third item is when there is any bank borrowing. It's not frequent, but that is also possible. So all these will be impacting our net interest liability on daily basis, interest payment. That will be feeding into payment calculation. So that means once you have rate fixing in order, you will have how much payment to be made on daily basis. So payment calculation. Now the payment calculation is not only inclusive of rates, it will also have the payment required for the daily trades. Or if the IM is expecting to buy a big lot of some securities, they have to move the money in advance, right? So that payment also need to be made. So how much I want to buy tomorrow, I will make the calculation today and will move the money into the trading accounts.
So the rate fixing and payment calculation, I mean, the valuation team comes into the picture in this?
No, because right now we are just trying to prepare ourselves for the buying of security next morning, right? So today, any liability or any loan that I have undertaken and I have to make the payment, I have to do that calculation. Plus, I also had to make the calculation for how much I'm planning to buy tomorrow. So if I am trying to buy 2 million worth of stock, I need to move the cash from the cash account to trading accounts, right?
Okay.
Which means maybe the JP Morgan trader or the Citibank trader, they need to buy 2 million worth of security of GameStop tomorrow. So the money has to move from one to another account. That will also come under the payment calculation. So rate fixing, payment calculation, everything clubbed together also will feed into the cash flow reconciliation, because of course payment calculation means payment is calculated and then money is moved from one account to another account, but the same data will be also used in the cash flow reconciliation, because eventually when I reconcile the cash tomorrow evening, I have to factor how much cash I had moved the day before and how much cash was used in the buying the security. So cash flow reconciliation, and that's where the cash flow recon and position recon work hand in hand. They are interrelated.
Thank you.
Welcome. Nihar, your comment on this is a very important, interesting piece of anything else you want to add?
Yeah, nothing to add, Nidhish, for that.
Yeah, thanks. So I saw.
Sir, I have a question.
Hand flag. Yeah, someone was raising hand, but the name was not obvious. It was some ID.
Sir, payment you know so like how it make possible.
You're breaking.
Come to know we are
hello, your voice is breaking. Could you please type into the into the chat box? That would be more convenient.
Yeah.
Sir, I have put some question chat box. Could you please check it?
Okay, what's your name? That Venkatesh, is it?
Sam.
Sam, is it? Okay, so I think your question is who is a counterparty? I think we went through who the counterparty. I take you're happy with that, Sam, right?
Sir, I got that, but I'm little confused that why in this process we are not including the exchanges and the depository and all the trade cycle we study in the historical. I mean, yeah, is like why exchanges and depository into this cycle.
Okay, so Sam, just bear in mind, okay, so this is not the case of one size fits all. So if you are looking at a trade cycle in private equity, it is different.
Okay.
If you're looking at trade cycle for sort of an equity, right? If you're looking for a trade cycle for bond, so which trade cycle are you referring to?
So the normal trade cycle, sir. I mean, like if I bought some shares, that life cycle, sir.
So just a standard share trade
Yes,
cycle.
sir. Yes, sir. That trade life cycle I was referring to, and that I have studied.
Okay. I guess that is quite a standard one, right?
Yes,
You know,
sir.
you
Yes, sir. Yes, sir.
yeah. So you have the buyer and the seller.
Yes,
You know, and
exactly, sir.
yeah,
Then we go to the agent. Yes, sir. Yes,
yeah. In this case, the agent, you know, is the counterparty, right? There's someone in between.
exactly. 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 Absolutely.
So you have the trade execution. You know, so you have the buyer and the seller of the securities or the financial products,
Mhm.
right? And then you know, then the
Right.
trade is
Right, sir.
executed. Trade execution through the settlement of the trade,
Right.
um, and that's the trade cycle for that.
Yes, exactly. Yes, sir. Yes, sir. Yes, sir. Yes.
So does that take care of your question? Does that answer your question?
So yeah, almost I'm confused with like I have studied cycle. Why it is different from this life cycle, but which we are studying right now.
Okay, so why is it different from the trade cycle?
I believe, and here you I would like to add this because it
Yeah,
depends on the products. I mean, if you are in hedge fund, there would be a difference in the trade life cycle that from the equity. If you're in private equity, because alternate investments and the equity, I mean, they are the two bars. No doubt, some of the activities would be common, but the trade life cycle would differ as per the products.
Yeah, definitely. So if that is
Okay.
that is a question, yes, Varnish, you're right. Because the trade life cycle, as the name suggests, it depends on the trade. And the trade from one type of fund to another type of fund will be different. Private equity trades into the private assets, the distressed company, suppose. Whereas the hedge fund will be trading into the exchange traded securities as well, and the derivatives. So their way of buying, selling, and their settlement, everything will be different. If I was into a private equity, I would be shopping for some startup and the company, and one agreement will be done in 3 months' time, maybe. Whereas in the hedge fund, like there are millions of stocks bought or sold by one company sometime in a day, right? So the frequency, the size, and the kind of the marketplace, everything is different based on hedge fund to private equity or maybe even mutual fund. Hence, the different type of life of the trade.
The scale of activities would also differ. I mean, the initial would be the trade processing part, maybe trade ticket and the execution, maybe there will be similarity, but the scale of activities would differ in every as per the product.
Yeah, scale is different, and then even the leverage. The private equity will be on the basis of the commitment and capital call, where the hedge fund will have its own cash as well as the leverage. Or it can use a margin. It can also use the collateralization, right? Repo and reverse repo in order to be able to buy or sell securities. It can go much beyond their own resources when it comes to buying or selling the securities, right? And
Absolutely correct.
yeah, that's where the other terms also comes in picture: hypothecation and rehypothecation. Even if do not have the security, they can use a short sale, or there can be some hypothecation whereby the custodian will lend you certain security on the basis of the security that you already have with the same custodian. So there are various such means and measures which the hedge fund uses. So someone has asked the question that, okay, the cash is transferred for the long, etc. But what happens in case of the short sale? In case of short sale, of course, we do not need immediate money. Actually, we generate money. We get more cash flow in case of short. And we only need the cash when we need to settle or when we need to buy back the security positions and return to the original party, maybe counterparty. Then we need cash to settle the short positions. At that point of time, we need to move the cash from the cash account to the trading account.
Yeah, I think I just want to add, right? So just coming back to Sam, right? So I don't want to get confused, Sam, as to why this trade is different, etc. Okay, but what I want you to understand, the main objective of every trade, okay, is to get executed at the best price, okay, and settle at the least risk, okay, and less cost, okay. So that is, I guess, you have the buyer and the seller, okay, um, and then you have the an agent in between, okay. So and then you start looking at which product, depending on the product, the processes will change. So as Nidhish touched on, in some cases you will need margin accounts in case of futures, for example, okay. But when you're trading forwards, you don't need a margin account, okay. And then and then also the processes of the trade ticket also changes, okay, because sometimes a trade ticket can be produced or by certain systems, but in some companies you have manual trade tickets where you have to sign manually and send it. So those, they are always sort of nuances depending on the product, okay. But also, you main thing, you need to keep the main objective of every trade, yeah, which is to get executed at the end of the day. Now the execution period also changes, so if you get to that kind of detail, you are going to confuse yourself. But I think you just got to look at the main objective and then work your way through every trade, and then everything will start changing. But the objective is that every trade should get executed. If it doesn't get executed, it means that it is not being completed. Yeah.
Absolutely correct, Neha.
Yeah.
All right, great. So these are the very interesting page. So moving on to the next one. Again, back to the trade cycle. So this is reflecting how various stakeholders or the parties of the trade cycles are connected to each other, and what are the different steps. So as you can see, the trade instructions start with, this would be the number one step. They start with the investment manager going to the broker, dealer, and sorry, again, we need to. Can those remain on mute when not speaking? So broker dealer will be then executing the trade with the exchange. Trade allocation is done. Confirm back to the investment manager, as you can see here. And investment manager then, as the next step, will interact with custodian or will clarify any doubt or queries of the on the trade with the broker. And this is where the settlement is also done. So remember, some trade will require the settlement with immediately, or if there is any derivative that will require settlement after a few weeks. So settlement is also done between the investment manager and broker dealer. Next step would be the broker sending the confirmation and affirmation to depository. So this is a step actually done by broker. So when the discussion between the investment manager and custodian is taking place, or investment manager is interacting with the broker dealer will also in the meantime will interact with the depository, will send the confirmation details, and depository will affirm basically to investment manager, and finally will settle with the broker. This has to be done on a very fast pace, within 24 hours, ideally. So settlement authorization, settlement confirmation, these steps are completed between the depository and broker dealer. The one that we have seen earlier, if you go a few steps back in the map, we had seen.
Because the step of settlement, I'm sorry, I'm interrupting you.
Mhm.
The step of settlement and the delivery, won't the custodian come in picture? It would be investment manager, broker, and the depository.
Sorry, can you repeat where the custodian
This,
will come in the picture?
I mean, the settlement and delivery instructions.
Mhm.
Would the custodian come somewhere in the picture?
Because custodian will come in picture when this has been confirmed, because custodian just need to know how much is bought or sold. Because custodian is not playing any trade roles here. The trade role will be between the depository and the broker. Okay.
So after execution, the reporting part would be with the custodian. Correct me if I'm wrong.
This is correct. Yes, sir.
Okay.
So here, custodian will play a FII role. It will be an FII role. And then they will update the records, adding the position for sell and reducing for buy. Sorry,
Reconcile.
opposite way. Yeah, adding the position for buy and reducing the position in case of sell, and will help in the reconciliation. And there will be one copy with the fund administrator as well, not to forget. Fund administrator will be also doing the reconciliation at their end, and will, in case of any doubt or question or break, will come back to custodian and investment manager. Primarily investment manager. Investment manager will confirm what is the right position. And if the investment manager confirms that, okay, fund accounting team's data is correct and they have the right position, then fund accounting team will go back to custodian saying that, hey, your position seems to be wrong.
Correct. So before pre-settlement, if I say execution, and after settlement post trade, so the custodian comes into picture for reconciling.
Yeah, they have to regularly reconcile. And also, of course, there are two type of sale, two type of services custodian also maintain. One is a specific account or account by account, and another one is a pooled account. So when custodian is offering account by account reconciliation services, they will do the reconciliation, otherwise they will maintain a pool. And thereby they only reconcile once in a month or once in a week basis.
Okay, thank you so much.
And now here comes putting everything together, portfolio accounting and reconciliation services. So this is more intuitive. Data retrieval, fund admin receive the trade files, means the quantity is confirmed, price is confirmed, bank date and swap details, etc. from traders. So data retrieval, when essentially all the information is collected from different stakeholders with regard to the trade, from the trade life cycle. Then comes broker download. Fund admin team has online access or maybe receiving the PDF on daily basis from the brokers and prime brokers.
Correct.
And there will be like 3-4 different time slot as well. It generally start depending on the location, 3 a.m. and it continues until late night. So at different time slots, practically speaking. So FCM and OTC counterparts, there are various technology and platform available nowadays, and it is all technologically driven. Next step is, of course, once the data is downloaded, data is retrieved by first fund admin receive the data from client, then broker provides the data. So two source of data is here, one and second. Now these two need to be reconciled. So trade reconciliation start after these two steps. And those reconciliations are done for equity, bond, derivatives separately, and especially OTC derivatives. Reconciliation are much more complex and demanding. So that is also reconciled separately because it also takes into account various cash positions and net liquidity value, NLV. There are various terminologies and requirement for OTC recon as well. So OTC recon is typically done separately than the position recon, cash recon, etc.
Could you please repeat the three statements what you give in OTC right now only?
3 settlements.
I mean, what you spoke regarding the OTC right now.
Okay,
the recon part.
so OTC reconciliation is more complex because of the cash involved as a liability, then net liquidity value, NLV calculation, and total settlement required on maybe every 5 weekly basis, because there are SOP and other OTC settlements there are calendar actually which is maintained for every 5-6 weeks. So those settlements are required because remember, in OTC world usually there is a liability and asset created, right? And asset for A and liability for L, they actually keep going up after some weeks, and based on the calendar we just try to settle it on a specific date, say 23rd of March. There will be some reconciliation done, and it is in reality the one of the quarterly reconciliation is done on say 23rd of March. So now you reconcile all your asset and liability on 23rd, right? Then from 24th the liability becomes zero. Again it will start to grow, and somewhere in June, first week of June, you'll settle everything. So this kind of settlement is done on regular frequency, and that's why you need to continuously do the calculation and keep it ready for the quarterly settlement.
If I'm not wrong, that would be on the basis of expiry date or somewhere as per the contracts. I mean, if a future is there, option is there, that would as per their cycle, correct?
Not only expiry could be say 6 months or 9 months down the line.
Okay.
So the fund will not wait for the expiration date, or it is not beneficial for anyone to wait because there could be counterparty risk if we wait for 9 months. Imagine in a GameStop kind of scenario, there will be like billions of the debt on the other party, and this will cause counterparty risk if someone has to wait for that long. That's why in order to avoid that, there are regular settlement required. So the future forward and all the swaps can expire in 6 months to 1 year timeline, but the fund cannot wait that long because longer you wait, higher the counterparty risk.
So the daily base fluctuation and the daily base, I mean, recon go side by side.
In the OTC world, you don't need to kind of settle on daily basis or reconcile even on daily basis, but it should be frequent enough.
Oh, thank you.
Yeah. Because ultimately you're not going to settle on daily basis anyway for such OTC. Then comes the Pnl reconciliation. As the name suggests, the profit and loss on daily basis should be reconciled vis-a-vis the prime broker file. With the Pnl reconciliation, we also perform often be it the fund admin team or the investment managers, both they perform some analytics, which is called leaders and laggards. What are the most performing stocks or the products? Which one is the most laggard? Which one is causing the highest amount of risk? And standard deviations, etc., etc. Those things are done. So that is called P&L analysis. And finally, the valuation. Valuation is all the assets minus liabilities. Assets are all the equity, bonds, derivatives, OTC product. Everything is reconciled on daily basis, and then we value them using various pricing methodology, valuation methodology, and asset minus liability, which is the NAV, is decided on daily basis. So it also depends on the fund. Some funds might not require daily valuation based on their size, based on their risk appetite, but most of the cases they want daily recon, daily valuation completed. Even though you can do the final NAV valuation once in a month, but these activities needs to be performed on daily basis.
And this will all be agreed in advance. It will be all be in the documents provided. So as Nidhish said, if it's especially after the 2008 financial crisis, the investors wants investments in the liquid assets, so they want daily pricing, assets that on a daily basis. So in case of any sort of market crashes, if you invested in so-called liquids, you can redeem it if it's a daily fund.
Yeah, thank you, Nihar. So that is the overall portfolio accounting and reconciliation step. Of course, there are two-way reconciliation, three-way reconciliation in the industry. There are various practices. They also are on the basis of what is agreed with the client and what client has agreed with their investors. So there is a chain of various agreement which decides whether the two-way reconciliation will be performed or a three-way will be performed. It will also attract a different amount level of fees by the fund admin and various stakeholders. It will also require kind of a more timely exchange of the data, because it is all the game of the data, and it has to be exchanged on timely basis. And of course, more and more reconciliation is performed, there will be more breaks, there will be more queries. Those queries needs to be also resolved on timely basis, because if the queries are not also resolved on time, you cannot really value the fund on time, and you cannot really perform the Pnl reconciliation, right? And at the end of the month, you need to decide the NAV. So the NAV date, which is already prefixed, like BD 4, 5, 6, 7, the NAV finalization will get delayed, or it could also be inaccurate, which is another big sin in the sensitive industry like a hedge fund. So all these things are agreed in minute details on daily basis, on hourly basis sometime in the first week of every month, so that not only the fund accounting team, but also the brokers, the client team, everyone knows their roles and responsibility with regard to who will be doing what and how soon they need to respond on the questions and the breaks. So these are some of the practical nuances in the typical fund accounting form. Or
Yeah, I think as you say, Nidhish, this is, I think, the key point. Everything has to be done on a timely manner, and I think which is where the whole automated reconciliations are already in existence, and we will see more and more of, because it will eliminate the risk of human errors, if you like. Not completely, but it will just mean that the automated recs will be more efficient as a process, especially in the hedge fund world, where you need daily NAVs. And if it allows daily I guess daily redemption and subscriptions, then it's even more critical that the P&L analysis and all the information is accurate. Because then what happens if there is an issue and if the trade is not executed on time, and if in the chain thing gets missed, and if the investor redeems or subscribes, and then it turns out that there's been a big swing in the price, that can obviously cause a lot of issues. And then then you have to look at the materiality. If there's a big market swing, then the board of directors have to get involved. They might have to redo the NAV. So there can be too many issues. So the critical thing is that the reconciliations and are happening in a timely manner, if that makes sense.
Correct.
absolutely, yeah. It's a very risky thing if anything goes wrong and one of the investor redeems, because recovering the money will not be easy if it is redeemed at a higher price. And you can correlate this to mutual fund industry as well, where the daily buy and sell also takes place, plus redemption and subscription are allowed on daily basis. NAV is published every evening for the next day buy sell. If anyone makes a mistake, it will be a blunder. So this, and to a great extent, the same is applicable for hedge fund as well, as Nihar said here. So now we can establish some of the objective of any fund accounting team as well. They need to maintain books of accounts. So this is where we understood the implication for recon, NAV, general ledger, maintenance, and all, plus all the data entry on regular basis, accruals, income, revenue, they have to be maintained. And nowadays, everything is done in a bulk upload as well. There are automation in progress in many fund admin companies. Deriving the profit and loss for the fund and the investor. So this means like the P&L needs to be distributed to the investor, right? And this is where we discussed earlier the series and equalization method. So ultimately, when the NAV goes up or down, and NAV is allocated to investors, right? We also allocate P&L, don't we? In the same process. Because once the NAV goes up from 100 to 102, essentially, there is an element of P&L as well when the NAV goes up. So these P&L are allocated to investors. So this is where they derive the profit and loss of the fund and investor. Now, ascertaining correct fund NAV, ensuring there is no misappropriation of the fund. So accuracy is key. And this is where, since the funds are growing and the complexity is also growing, companies are very proactive in automating the business so that they can reduce the error and can work more efficiently, not only effectively, because with the time, the management fee is also shrinking. Since management fee to the investment manager are shrinking, there is also a pressure on the fund admin fees. So as the fund admin fees is going down, there's a much bigger pressure to automate things. And that's why nowadays any good fund accountant need to be also well conversant with various automation methodology and how to make their process and business more efficient and fast, how to reduce over reliability on manual entries. And if is the final step in the calculation of NAV, hence very critical. And finally, the same team usually prepare the financial statement on annual and semi-annual basis and work with auditors and the client to finalize them. So this is where you'd have seen people working and very busy during the year end, especially in the month of January, February is very, very busy for fund admin professionals, especially those working on the financial statement. Because maximum there is a 90 days time before the financial statement has to be finalized. And prior to that, it has to go through several levels of checks, control, audit, sign off, review. There are 4 or 5 levels of review required before the financial statement is signed by the board of directors. And the
absolutely correct.
Component of fund accounting, what they do on regular basis, pricing. Of course, the valuation cannot be done without pricing. And there are like valuation policy documents and various steps required for that. Journal entry, reconciliation, month-end accrual, and P&L, etc. So how high level, what is the financial position of the NAV? All the assets minus the liabilities, and operations will maintain the details of the expenses, cost of operations, income from the security sale, also various other ancillary incomes like from the interest, cash accounts. This number needs to be maintained as part of the trial balance. Accounting policies are important. Of course, we cannot go into the depth of this, but generally, the popular accounting standards are GAAP. GAAPs are normally called short name for the US generally acceptable accounting standards. So GAAP and then IFRS, International Financial Reporting Standard. These are two main gaps under which the financial statement and the NAV is prepared. Because these are the standards which decide whether one has to follow LIFO accounting or FIFO accounting, how the valuation needs to be done, what is the level 1, 2, and 3, basically, when it comes to the pricing of security. It is an important component, and these are governed by the accounting standards. Level 3 is most opaque, and 1 is most transparent level of price. Then comes the valuation of the firm, the complete measurement. Then we disclose or we recognize the asset and liability. And later on, the notes, which is providing the details of all the different security, how they are valued, what are the accounting standard, what are the different definitions. Because the disclosure notes will also include something, say, liquidity table or liquidity risk, sensitivity risk, credit risk. They are core a critical component of any financial statement or even the NAV, because any investor or the investment manager should be well aware of what are the counterparty risks that they are having. What is the liquidity risk? Because we know there are say 10 different investors in the fund, and they all have invested with definitely certain lock-in period. But after the lock-in period, they might divest money. They can withdraw the money. If two investors decide to withdraw the money, what will be the liquidity risk if I have all the investment into the long-term securities? So these are the components that one needs to understand, need to report as per the relevant accounting policies and standards. So this is where the measurement and recognition comes in picture. Measurement means measuring the value of the security, asset and liability. And recognition means putting them into the NAV sheet or in the balance sheet or P&L. So measurement, recognition, disclosure, everything is governed by the respective accounting standard, whether we choose GAAP or IFRS. Of course, GAAP is much more rule-based, so the popularity is reducing for GAAP because it is still easy to kind of misrepresent the numbers if needed, if the directors want, maybe, though it doesn't mean that people do it. But IFRS is much more holistic and much more substance-based. So IFRS is principle-based. So it puts more onus on directors to provide the truthful and correct information rather than just following the rule of thumb. So IFRS is much more comprehensive and popular in that regard. Any question?
Nidhish, could you please put the 26th slide? I just want to go through.
26. Okay.
Yes. This is in context to hedge funds you have written, na? The price, the month-end general entries, the month-end reconciliation, month-end accruals. And if we take the into context of mutual funds, that would be on daily basis. Correct me if I'm wrong.
True. So this is everything that we are talking about is with context to hedge fund. However, mutual fund is, yeah, of course, on daily basis, but even the hedge funds, some of the hedge funds are reported on daily basis. They require a correct daily P&L.
What about the private equity? If we talk about more or less the same.
No, private equity is a long-term investment, right?
Mm-hmm.
So one private equity would raise the fund, say $1 billion, and will invest into 10 different companies in the portfolio, maybe 100 million to 50 million each. So there's no real benefit out of daily valuation. So those valuation is done. The most frequent is on monthly basis, or they typically do it on quarterly basis. because the
And
company's
what
value is not going to change substantially on monthly basis anyway.
and what about the real estate?
Real estate is done on either monthly or a daily basis, because they can be real estate fund, real estate index tracking. Their value can fluctuate.
I think general trend with real estate is either monthly or quarterly. You don't see daily with real estate. With infrastructure, um, but I think with mutual, as Nidhish said, it's obviously daily. Hedge funds can be daily, but the general trend is again with hedge fund. As Nidhish said, it's a Pnl might be required by a client on a daily basis, but the valuation, I think, generally speaking, is on a monthly basis. So yeah, but again, it all depends on what the client wants. But these are the general trends.
Okay, thank you so much.
And one more thing to note, actually, though the NAV reporting might be depending on the requirement, daily or monthly for hedge fund. However, even though the NAV is required on monthly basis, the fund manager will insist on daily PNL. They can still insist on daily PNL, because that will give them a very clear view how much profit and loss they are making on each security on a regular basis.
Absolutely correct. Thank you.
And there can be also ad hoc requests. The market is going crazy, fluctuating.
Yeah.
So the client might say, listen, can you do an ad hoc NAV calculation or Pnl calculation? For various reasons. They might want to see the cash management, or they might be worried about X amount of forward selling, and whatever it may be the reason.
Absolutely.
So, yeah.
So there is a provision for that as well. I mean, if client wants it on the daily basis, irrespective of the fund cycle.
Right.
Yeah, of course. Yeah.
It's all about feeding the data into your system. You feed the data, do the pricing and evaluation by the team, and they can calculate the NAV on daily basis for a couple of days. Because remember the situation which occurred in 2016, there were like globally billions and billions of the redemptions on various hedge funds in I think mid of 2016. In that case, many investors and the hedge fund managers started to ask their NAV. Sorry, can everyone please be on mute? We're not speaking. So many hedge fund managers and investors started to ask the NAV and performance report on daily basis for a couple of days, because whenever, as Nihar said, there's a panic in the market because of, say, too much trading or redemptions or any financial meltdown, then everyone is in anxiety and the panic. The hedge fund managers wants to know how their portfolio is performing, what is the really amount of cash, etc., and what is the liquidity. And investors also wants to know the performance on much more frequent basis, so that they can take more informed decision, and they can also create some scenario analysis. That's why this can change, and you have said it could be even ad hoc basis. So of course, we are talking about the monthly or daily, but some funds might have monthly reporting, but suddenly one fine evening they can come back saying that for next couple of days we want daily NAV and PNL report, because there are some urgency, there are some unexpected situation.
Okay, thank you so much.
Okay, thank you. So this is how, or maybe this is what we report on the NAV or the performance. So especially when it goes to the investors, we need to ensure some very minimum information are provided. So starting NAV, P&L for the month, expenses ratios, gross return. They are some of the return ratios or high level numbers that is provided to investors. Of course, fund to fund, it can vary. Investors' preference can vary, but this is just to give you a high level understanding. Incentive fee for the month, which is important. Net P&L, what is the net return percentage? So what was the starting NAV and how much is the ending NAV? So entire things can be reconciled in such situation. Plus, it will also give you the key performance ratios. It will also give you a view of how you started this month and what is the ending NAV and what was the constituent number, how ending NAV is arrived at. So this is a quick glimpse of what we supply to investors and how the performance are calculated. Moving on, now we have a large section left, but we'll try to give you a quick idea as fast as possible. So all the hedge funds that we talk about, the NAV fund accounting process, actually so far we have not discussed the strategies, because not all the hedge funds follow the one single strategy. There's no one size fits all. There's no generalized strategy. All funds actually differ when it comes to the strategy they follow. So in that regard, I can maybe talk about a very high level different strategy, and then we can just touch base on some of the PPT as well. So let's start with emerging market strategy. Or Nihar, you want to talk about some of the strategy with some examples, or I can proceed?
No, I guess just a very quick one.
Just
a very quick one. So you could have you could also have, as you say, event driven, or you could have equity, or you could just have a strategy in line with certain BlackRock fund, for example. So you could have just a BlackRock equity strategy. So effectively, you are just aligning with the strategy of a high performing mutual fund. So and you could have actually multiple strategies within the same fund, right? So you could have a multi-strategy, and you could have various different sleeves. So you can chop and change in many different ways.
Yeah, perfect. Yeah. So and you have said some event-driven, multi-strategy, and there are some global macro strategy. There are various strategy of the hedge funds. Here, I would like to give you some quick glimpse of what they are, how they look like, and what is the pros and cons of investing into those fund strategy. Right. So let's start with emerging strategy or emerging market. Okay. That's what I was showing here as well. So event driven could have distressed security, high yield, and then as Nihar said, multi-strategy. Then we have relative value, which will also encompass different sub-strategy, basically. And then there are directional funds. In the subsequent pages, we have various other details of each strategy. But here, I can just give you a quick idea of, each strategy one by one. So if I have to explain emerging market, this is one of the very popular one. Actually, it started somewhere 30-40 years ago, 1981, in fact. So Anthony Agtamil, he was working in International Finance Corporation in the World Bank. So he coined this term, emerging market, and now it is quite loosely defined. Because what happens in this kind of a strategy, the funds are invested into various countries, maybe India, Russia, Brazil, China, all the emerging markets. Size can vary. It could be small, maybe 10 million, or it could be 20 billion as well. So it can be of different size and diverse. Okay, and they are considered emerging market strategy because they develop with, so they invest into the emerging countries. Like I give the example, the BRICS country, Africa, and various other countries. The reason is that they provide not only diversity, but also they are good for high return, because of course they have some element of risk, but on the same time, since the emerging countries are growing quite at a fast pace, it will also provide a good economic return. Just like China, which used to, or even is, the economic powerhouse, manufacturing powerhouse, whereas India is service powerhouse or service centers. So in that way, it provides a very good return to investors. On the same time, it could be risky as well. But we know risk and return goes hand in hand. Now, that is emerging. The another one quite popular is and colorful is multi-strategy fund. As the name suggests, it will have some sort of maybe convertible bond in the portfolio, and it can have arbitrage. Arbitrage is a term when there are two different prices in two market, and a fund try to take the benefit of the price difference in two different market. So it can use arbitrage strategy, it could be use convertibility, or it can also have some flair of equity, long, short. It can also bet on certain market movement or speculation. So when it is used different type of strategy, mix and match, it becomes multi-strategy. So suppose a convertible bond manager will try to gain extra return by shorting in one stock, maybe TCS or Facebook, and on the same time will try to have some convertible bond as well, because the bond which is convertible at a particular price, when the share go up, it will convert into the equity. And since the company has already, or the fund has already sold short some securities, so they have to return, right? So if they have to return and the price is rising, the fund might make loss. So the fund manager will be very smart in this case. They will buy some convertible bond so that the bond can turn into equity when they have to return it to the original shareholders. But if the market is good enough and share is still low, share is actually at a lower price, they can buy from the market. So in that way, they are happy in either case. So that's how multi-strategy funds are working.
When you say that they will buy for the bonds and that can be converted to equity, they will go for the convertible bonds.
Yeah, so they will have the convertible bond as part of the multi-strategy. So multi-strategy fund will use convertible bond as one of the security, one of the investment, especially when they have shorted some stocks in the market.
Thanks.
This is kind of a hedging technique. We know we are talking about the hedge fund. Hedge fund is all about hedging your profit. Of course, when it started some 60, 70 years ago, the objective was to hedge, but not anymore. It is having objective to make profit, but they try to still hedge. And the best way to hedge is that you sell short the security, and you also keep some plan to have security when the market goes up, because if the security in the market goes up and you have shorted, you'll be in trouble. So you need to have a convertible security so that the security converts into equity and you can return back. So that kind of arrangements, right? Third big one is global macro funds. Okay, so one of the example let's start with one example. That could be when around 1998, there was a crisis in Japan. Japan generally is a good economy, but it suffers often from deflation or stagflation. So the interest was extremely low. I think recently 2-3 years ago, it went into the negative zone, basically. So what happened is D. Brouwer fund actually started to borrow from Japan almost $200-300 billion at a extremely low interest, and invested into the major countries where the interest rate was high, such as treasury bills, and it made massive profit. So this kind of profitability is generated using global macro fund, because they will look into the direction of the global economy, where it is going. Is it going towards recession, or it is very buoyant, or are there bubbles? Is Russian economy going down, or Chinese economy going up? So accordingly, they will take the positions. They will try to short in one economy, go long into another one. That kind of macro event-based investment at a global scale, again, is called global macro fund. Another example I can take is George Soros fund. Soros actually back in 1992 bet almost $10 billion. Okay, and their hypothesis was that British pound would be devalued. And on that basis, the investors got almost 1.9 to $2 billion of profit, just betting on the direction of the British pound based on several economic indicators and macro events. So that is the benefit of the global macro fund. In terms of the risk, it is moderate risk, because generally the return is not extremely high, as the economic changes are not very sharp normally. So it is moderately risky, moderately profitable. Okay. The other one, which is again quite big in size, is fund of hedge funds. So Neha, anything you want to add for the global event funds?
No, I think we're good.
Great. So fund of hedge
Nidhish,
fund.
I'm sorry, I'm interrupting you. Just making a synopsis of these three strategies, what you've said. For the emerging market, I mean, we can say that from the suppose if there is a boom in the service sector, then manufacturing. So it is shifting from one sector to another, basically the emerging market strategy. Correct me if I'm wrong. And in multi-strategy, it is depends on the, I mean, the suppose convertible bonds are there. So if the equity goes up, and that would be the interchangeable into the assets, that would be multi-strategy. And the global strategy is changing into the economies. Suppose in China something is going well, so they can enter into the economies better, move on, shift or jump into the China rather than other economies. Correct me if I'm wrong somewhere.
No, that is not multi-strategy. You said that last one is multi-strategy.
No, global economic strategy. The
Yeah,
example
global.
you quote for.
Yeah, the global economic is global macro strategy will.
We can shift into the economies. I mean, jump into the economies as
Yeah,
per the performance.
yeah. So that focus on the economies of various countries or the group of countries.
Okay,
So
thank you so much.
you may choose to go long, means like bet heavily on the performance of the Brazil, India, China, BRICS country, and then you can think that, oh, Japan is not going to perform much, so let me go short on Japanese economy. So that kind of a strategy is global macro strategy.
And the multi-strategy, you were into shifting into the assets as per their performance, right?
No, not as per the performance, but basically you try to use mixture of different strategy. That is multi-strategy, like convertible. That one example I gave was for convertible. Second could be speculation, or the third could be leverage. So you'll use varieties of different type of strategy in the multi-strategy basically, and because it will help you take the advantage of different type of strategy rather than just going into one and facing loss or losing the benefit of other strategy. So you try to kind of do mix and match. Now, the problem with that is in the short term, you are not likely to make massive profit, because what happens is in the short term, one strategy goes up, one strategy is very profitable. Say in the current market, things are picking up. Many people want to become speculative. So if you're speculative in the nature, you might make good profit, but then other strategy, which is kind of a moderately risk, they will reduce your profit. So multi-strategy does not give the strong performance in the short term, because it will average out. All the performance will be average out because you are pursuing so many different strategy in one at a time. Now, but in the long term, multi-strategy is quite suitable, because risk-adjusted performance of the multi-strategy is considered to be higher than many other strategy, because since they are using diversified type of strategy, varieties of different strategy, so the risk is less than many other funds. So risk-adjusted return in the long term is higher for multi-strategy funds.
Okay, thank you so much.
Wow. So the other major one is funds of hedge funds. As the name suggests, basically, this is a group of fund. Say, let me just make a picture. Fund of hedge fund. So also called FOF. So one FOF is investing into various hedge fund. And what do you think that they will be investing into? What type of different hedge funds? It can have different strategy as well. The one can have strategy 1, strategy 2, strategy 3, so on and forth. So fund of hedge fund will invest into varieties of different funds pursuing different strategies, because that way, just like multi-strategy fund, this will also get a strategy of the exposure to varieties of different strategy, or maybe into different economies, different sectors. So that way, fund of hedge fund will try to cover a mix of everything. Now, the problem with that is, again, in the short term, performance will not be very stellar. And one of the biggest disadvantage of this is that the fees are charged twice.
Because there are different IMs.
Correct. So one IM, because this is anyway, all of the portfolio of the fund are hedge fund itself. So they will be having their own IM, an entire hedge fund team running fund one. Fund two is run by another hedge fund company. So all the hedge fund company themselves, they will be charging management fee, incentive fee, and different type of operating expenses for each fund. Now, after this hedge fund, so on and forth, all of this, we are charging various IM fee here as well, which is management fee and incentive fee. So effectively, the $1 which is invested by one investor into the fund of fund, it is charged twice, all the different type of management fee and incentive fee. First at level 1 here, and then level 2 here. Twice.
Level 1 at each hedge fund where it has been invested. Yeah, and the level 2 is FOF, single fund.
Exactly. Just like any hedge fund also charged for themselves.
Correct.
So $1 is facing so much of the fees, which reduces its performance and increases the operating expenses. And of course, because of so many different strategies being pursued, it becomes the average return of all the funds as well. So this is well diversified, no doubt, less risky, no doubt, but it is average performance of all the funds with high operating expenses. Then comes some event-driven funds. There are some funds which are event-driven. So they bet on a particular direction of the event in the world economy, maybe towards recession or recovery, or maybe event also mean there is a lot of discussion on Bitcoin, or there is another coin like ephemeral, etc., Ethereum, right? So they will focus on this kind of hot and debated issues and the direction of the world economy. So they focus on a particular event, and it is quite similar to opportunistic fund as well, because opportunistic fund to focus on a particular opportunity. For example, imagine there was a lot of discussion around Facebook nowadays. The government is trying to break the Facebook, or there's a lot of data and security related issues. And imagine for 5 seconds that Facebook stock started to go down, and there was some panic. Government breaks Facebook in 3 parts, and security started to crumble. Then somebody would have written some credit default swap on Facebook. So in that case, opportunistic fund will jump into this scenario and will try to take the advantage of the climax after all these discussions. So they will invest in a way they can make good profit. Maybe shorting, maybe buying at a lower price. Maybe they will go, they will take a lot of margin and go long into FB, knowing that after some time it will recover, or they can have some convertible security. So they are opportunistic funds as well. They are also called activist investing.
Created with purpose, right?
Yeah, created with purpose, but every fund's whole purpose is to earn profit and improve the performance. But they will just focus on some kind of opportunity in the market, which could be temporary, but they can still reap a lot of benefit from that opportunity. And that's why it is called activist investing.
Okay.
So there are campaigns by major hedge fund managers on large cap target companies, and they have attempted to change the entire corporate landscape of such investment. So because they can also be very harmful for some companies. If a company start to do bad or have some temporary financial distress, the opportunistic fund can create further havoc for them.
Correct.
Right? So
You
with
take
this, I would like to, yeah.
just I mean last question. You take Bitcoin into picture in event driven. How this come into picture, and what would be just a small example if you could quote.
Okay, so the Bitcoin, do you still see the PPT? So Bitcoin and event driven. Okay, so what is happening? A few weeks ago, Bitcoin was crumbling, going down. Then Mr. Musk jump into the picture. It started to go up. Then some people came and saying that okay, now Elon Musk will sink in some time. So we know Bitcoin is going up and down. Then there is Ethereum, etc. So an event driven fund will essentially go trade into options. Rather than going long, they can also trade into options. They would see that okay, it seems that Musk has bought it and it will go up. So they will try to buy a lot of call. So they'll go long on call options to buy Bitcoins at a favorable price, right? At the lower price, because I think it will go up and they have to just pay some small premium, 2% at the start, and they can get a lot of this. Just in case it doesn't work out and it goes down, what they have lost, maximum 2%. Or maybe
yes,
they will try to buy they will try to buy this, and they can also short some of the options. So both way one can play around based on the, so now you can see it is purely on the basis of the events in the market.
Correct.
Of course, one can also argue that some element of the event driven can also be opportunistic. Yes, I agree. So there is no clear borderline between opportunistic or event driven. One can argue that event driven can be opportunistic in some cases, or opportunistic can be global macro in some case. Of course, it can be. It is just like overall philosophy of the fund and the trading strategy, but it doesn't mean that they are not overlaps. If I were to draw a picture on the overlap, it could be like this. So event driven, EV, right? And this can be distressed. And then another one can be global macro. And also there's a long short. I mean there's a long list of the fund strategy. There could be long short. And that could be something like, I think it could be something like this. Equity long short. Because when you go long and short, you cover almost everything. You can go long in any security, you can go short in any security. It can be on the basis of global events, or it could be on the basis of distress or some event-driven, right? So it's very hard to kind of clearly bifurcate and draw the borders and lines. Yet it is possible to overall understand which fund is interested in what type of structure.
Also important to note that, for example, you brought up Bitcoin, but that is a new cryptocurrency is a new asset class. So not necessarily that just because it's an event-driven strategy doesn't mean that the new asset class will be introduced. Okay, but this is just for understanding that we are saying an event has occurred and a hedge fund manager might opt to go into cryptocurrency, which is a new asset class. but then another asset manager might not choose to go into a new asset class, and it might stick to the existing asset class as per the investment guidelines. So it just varies.
Yeah, bitcoins are globally legalized, accepted, or in some parts of the whole globe only.
But I'm just saying it's a new asset class. So not every event-driven fund or every hedge fund will want to go into a new asset class, and they already have a predefined uh, asset class in their investment guidelines.
Hmm.
So there's no one size fits all, but we are just trying to give this as an example.
Oh, great, thanks.
Absolutely, absolutely. And maybe here, since we have already exceeded the time, just in 5-10 minutes, I would like to give a very brief idea on risk ratios. Okay, because
Sure.
when you have said that not every fund may like this, not every fund will go for everything, and the basis is risk and reward. And there will be some investment strategy documents which will clearly outline that how much risk the fund is aiming to take. So to have those risk objective implemented in the portfolio, companies try to actually company builds different risk parameters in their strategy, and those risk parameters are defined by some ratios like Sharpe ratio, um, and Sharpe, Sortino, trainer ratios. There are various ratios which help investment managers track the risk that they are taking. So let me just jump to calculation sheet. Of course, we cannot go through everything. I have various document and ratios basically to showcase, but I'll just give you a quick idea how they are calculated. So say, for example, are you able to see the Excel?
Yes, yes.
All right. So there are five time periods and yearly returns are given. Okay. Now we also have risk-free return. We generally call it RFR as per the CAPM. We know the CAPM basically start with the required return, and these are the ratios and these are the numbers quite important for hedge fund professionals and hedge fund managers. So required return is typically, it's not writing, RFR, risk-free rate, plus beta times again risk, market risk actually, market risk minus RFR. This is also called risk premium. So this is how we calculate required risk. And the meaning of RFR, as you can see, is risk-free rate, something that that you expect from the government or the post office return. So a return which is absolutely risk-free. So every fund, hedge funds have to exceed, right? That is the expectation. They have to exceed the risk-free rate. So there we'll have yearly returns minus risk-free rate. So we have excess return for every year.
Correct.
We can take the average of all the excess return, and we can also take the standard deviation. So standard deviation is quite easy. We can write STD V and take the all the excess return for the period. Okay, so just type STDEV, standard deviation. So and take the excess return. It's not average return, by the way. It's the excess return between the actual performance of the fund. So column B shows actual performance. C shows that hypothetical or maybe your actual risk-free rate. And then this is the excess return. Take the standard deviation of all this, okay, which is here. And then you arrive at the Sharpe ratio by dividing the standard deviation by the average excess return. What Sharpe ratio is telling them? Any idea? So Sharpe ratio is saying that for your excess return or maybe average excess return. That means your performance of the portfolio. Stop me anywhere if I miss anything or if there's any doubt. Performance of the portfolio minus expected return divided by the standard deviation of the portfolio. Standard deviation is what? If I have to talk in a very layman sense, standard deviation is a fluctuation of my performance, right? So if my performance has a fluctuation, then there will be a line, one common line between that, which will show the standard deviation, like how frequently or how much up and down my portfolio has. So that is like loosely speaking standard deviation. Now, standard deviation will divide my excess performance or excess return, because I want to understand that for 1 unit of standard deviation, how much excess return I get. Okay, now if you are with me so far, let me further simplify this. So I will repeat, for 1 unit of standard deviation, how much excess return am I getting? Now you say that why I'm asking this question, why it is needed? Because if I'm taking 1 standard deviation of risk, standard deviation is a risk, right? That you are sure. 1 standard deviation is a risk. So I'm saying that if I take 1 unit of standard deviation, how much additional sweet I get? Because I can't take any additional risk. I would love to have my RFR basically risk-free rate only. But if you give me some additional return, then I'll say, okay, I'll get some additional risk. So that's why I'm saying I'm ready to take additional risk, but how much return are you giving? That's why I try to divide the excess return with standard deviation, so that I know that for 1 unit of standard deviation, which means 1 unit of risk, how much additional return are you going to give me? That's what the Sharpe ratio is. So
Nidhish, I mean, the standard deviation and average, could you please, I mean, how do you get to come this arrival, that standard deviation and average? Just explain that part.
Okay, so here I started with yearly return. So the fund is performing, say, for 5 years or 5 months or 5 weeks or 5 days. So 5 time period.
Okay.
Then your yearly returns, right? Pnl performance divided by that.
Correct.
Now,
Correct.
then risk-free rate, the government or treasury bond return, risk-free return. So I have excess return, right?
Correct.
Actual return minus risk-free rate is the excess return. So if you have 5 days or 5 weeks of excess return, then what you can calculate? Excess average return, right?
Okay.
Yeah.
Okay. Got
So
it.
this is the excess average return. So that means, like, if I'm taking 1 unit of excess risk, how much more return I get? So here I'm calculating average additional return, and then I calculate standard deviation of my portfolio. So here is the excess return of the portfolio. But you see, it is not consistent. It is up and down. You see, in the final period, it is a negative as well. -2, 3. That means there is some roller coaster. There is some up and down. There is some volatility. And I don't like volatility without any return. So I'm saying that, all right, how much additional excess return will I get if I'm getting 1 unit of standard deviation? So that's why I divide average excess return by standard deviation.
How did you come to know this 0.29 figure?
That is standard deviation of this entire portfolio. So this is the portfolio. Just take STDEV.
Okay.
You got it?
Got it. And what is the formula exactly? It is just the standard deviation.
Just equal standard deviation and all the 5 number.
Okay, good.
Yeah, the actual formula, if we use pen and paper, it's quite long. It is actually the standard square root of the variance, and variance is the individual performance minus average performance by the number of units. So there is a long step for manually, but on Excel we can calculate it quite easily.
Okay, thank you
This is
so
how
much.
we calculate Sharpe ratio. Actually, we are now we have exceeded the time, but you can just understand the Sharpe ratio is the most important and the frequently used the risk measurement parameter in the hedge fund industry. We also have, you can just keep in mind, Sortino ratio as well. Sortino ratio in brief is the kind of variation in the Sharpe ratio. So if your Sharpe ratio is also varying for your portfolio year on year, that is called Sortino ratio.
Okay, got it. Thank you so much.
With this, you have a fair understanding now of hedge fund risk profile. Okay.
Thank you so much, Nidhish and Baldev. I mean, hats off to you. I can just say I had no words. I can adore you. You are the real gems of the industry. Thank you so much for your time.
Welcome, guys. Thanks, Panish, for all the questions, and it just makes all the discussion much more lively and interactive. So we are equally excited to get these questions as well and explain this. So any other question before we close? We'll be coming back with a couple of other such sessions as well in the future. I had to check the calendar of myself, Nihar, and any of the participants. In future, again, on one of the weekends, we'll revert with some other topics like this. We'll stop the hedge fund discussion because we have already done one session and this was the second session. So almost we have discussed this for 4-5 hours. Now we would like to kind of discuss maybe the stock market, or also we are planning to bring one such session on cryptocurrencies, Bitcoin, cryptocurrency, how they work, what are the technology behind them, what is the due diligence, what is the compliance and the fiduciary requirements and how they work. So we are going to talk about cryptocurrency also in one of the forthcoming sessions. So kind of stay ready with that. And
if you can add private equity and real estate to agenda, that will also be more attractive. Just for a suggestion. Thank you.
Yeah, actually we have done 2 sessions on the private equity kind of some 1-2 months ago. That's why I'm trying to right now skip. However, I take your point. The private equity can be repeated in future, but I just want to kind of complete some of the fresh topics. In fact, since we have completed the session of the 4-5 hour session on the private equity already, and there's still massive demand for like a longer session and much more intense training, we are also in the process of launching the diploma and certificate program of the private equity. That will be like 30 to 35 hours long. It will have various doctorate and the industry leaders and experts of the private equity, and it will be like a completely formalized step-by-step training program. So we are also in the process of launching that, because 4-5 hours is still like a tiny as compared to how fast the industry is. But yeah, stay tight, and we'll be kind of giving maybe another session in some time on the private equity. But now we are planning to have one full-length course. But some other topics like stock market investing, cryptocurrency, financial modeling, IFRS, those things will be also coming in this kind of discussions.
Would be eagerly waiting for your courses. Thank you so much.
Oh, thank you so much, Ganesh.
I think Sam has a quick question.
Okay.
Why is RBI banning Bitcoin? So we don't know what's happening in terms of why RBI is banning or is it banning, but we will cover cryptocurrency in that session because it's a long process to go.
Okay. And sorry, someone can mute the music, please.
Can everyone mute? Who's not speaking?
Let me just check with this.
Yeah, but I guess if no one else has any questions, Nidhish, will we wrap it up here?
Yeah, indeed. I think we are all sorted. I know it is kind of a very last minute question. Just I observed one on the gated redemption. So basically, to give you an overall flavor of the redemption, when investors make the subscription, the offering memorandum document and the PPMs actually put the terms that when and how much and how the redemption can take place, and there are various time frame and there is a lockup period as well. Before the lockup period, you cannot redeem anything. And after the lockup period, then there are also various milestones when you can withdraw the fund at different stages. And if you try to withdraw before the given milestone or before the permitted time, there will be a charge and there will be penalty, right? So when such terms are put in place, and then the amount is also specified for the redemptions, they are called gated redemption, basically. So you can't exceed certain amount on a particular date. So that is a gated redemptions. Okay, Venkatesh, that was your question. I just saw. So
Yeah, generally they apply 25% on maximum redemption, etc., etc. Yeah.
Right. So I think with that, we have completed all the question answers. So thank you so much once again, everyone, including Varnish and everyone who asked the questions. We'll see you again in next weekends, possibly.
Thanks, everyone.
Thanks all. Take care. Bye-bye.